very few SBA 7A lenders will do a fixed rate term. And probably rates will come back down, hopefully. They're going up right now, but I think 12 to 24 months from now, they may start coming down again. These come with a 3-year prepayment penalty. So on something what I consider a value add like this, because it's got no income and you're going to make a bunch of income once this is operating, you're going to want to refinance anyways. So instead of going into a 504, which has a 10-year prepayment penalty, the 7A would be better because it has a 3-year prepayment penalty. And now, a word from our sponsor of this episode. Honeycomb is transforming the way insurance is done. Their state-of-the-art technology is next to none. You can quickly enter in a few data points. Their technology goes out and gets you a quote within 5 seconds typically. They cover single-family homes, medium-sized buildings, condo associations, HOAs, landlord policies. That's their niche in insurance coverage. Their typical policy on average is 40% less than the competition. So if you're looking for an insurance quote, Honeycomb is your solution. Honeycomb is transforming the way HOAs and landlord insurance policies are covered. With their state-of-the-art technology, you can enter in a few data points and their technology goes out and can get you a quote within 5 seconds. So if you're used to dealing with the old school insurance providers, you have to answer a bunch of questions and it takes hours, if not days, to get your quote back. Well, with Honeycomb's technology, that's all changed. They're top rated insurance by AM Best. They're rated excellent. There's many advantages. They do single family homes up to medium sized buildings, and these are landlord policies. As a lender myself, I know the importance of having a great insurance partner like Honeycomb. So I strongly recommend you check them out and get a quote from them. Hello and welcome back to another episode of the Investor Financing Podcast, where we dive deep into the Q&As that are coming over. So we're getting a lot of questions and answers, or at least questions, and I try to answer them. If you go to investorfinancingpodcast.com/ask, you can ask your questions and we're going to answer them live when Bill and I get together and record. So we've got, I think, 3 or 4 questions today, and Bill will fire with the first question we got.
All right, this one comes from Matthew. He says, I am looking at purchasing an old motel. It's vacant now, but it is a really good place to renovate and run as a boutique motel. We would showcase the units on Airbnb and VRBO or VRBO. I don't own any hotels currently, but I do own and operate 3 short-term rental properties, and they are single-family homes. I have great credit and will keep my W-2 job for the time being. I earn around $300,000 per year. I should add the property needs about $800K in renovations and FF&E, and they are looking to sell at around $2 million. How would you structure this loan? What could I expect for terms and loan proceeds? Thanks in advance.
Okay, very good. Well, we get these questions all the time. We get right now, owning and operating short-term rentals is a good business for many people. They're making good money and enjoying the business and growing the business. And a lot of people start wanting to get into larger assets, like Matthew is talking about, where they want to buy maybe a vacant motel or an operating motel that's just not performing. It's mom and pop owned. This one is vacant. I don't know why it's vacant. So first I would kind of cue in why it's vacant. What's the history of the building or the property? Then you gave me some good cues. You already run a business that's in hospitality. So you're showing experience. And I'm trying to match up these kind of questions with what SBA would be looking for as far as guidelines. When I say SBA, it's what's the banks that are funding SBA type of loans. Because remember, SBA does not make the loans. They guarantee a portion of the loan. So the banks make the loan. So first of all, we're going to find an SBA bank that likes hospitality, because some banks will not lend on hospitality no matter what. It's just not their appetite. So when we look in there, so we have a vacant property. So this is a startup. We could potentially look at it as an expansion if you have 2 years or more of history with your business, which we don't know. You didn't put in there. But most likely we're going to look at this as a startup no matter what. And what I like is that you make a good amount of money, $300K W-2. Maybe your spouse makes money too. You're going to continue the job. So that's really good on a startup, is that you're going to continue to make that $300K, right? And I'm assuming your debt to income and your global cash flow is good. So from a borrower standpoint, it sounds good. I would probably like to see at least 2 or 3 years of experience in short-term rental, not just 3 or 4 months. But it sounds like if you have a year plus of experience, maybe 2 years would be optimum at least, then an SBA 7A loan would be a good choice. And an SBA 7A on a startup, you're looking at 80 to 85% of total project cost. So we can fund the $2 million purchase price, $800,000 CapEx. So that's $2.8 million. And that's including FF&E. For people who don't know, FF&E is furnitures, fixtures, and equipment. So that's 2.8, plus we would finance interest payments for the first 12 months, most likely. So we'd build in an interest reserve of payments. So you don't have to make payments when the property is vacant and you're doing construction. So you're looking probably at a total project cost of like 3.2 million when you add in the SBA guarantee fee and all the fees and the interest reserve. We'd also build in operating capital for the first 3 months or so where you can pay your staff. So we're gonna put this all out in a sources and uses, and we're gonna come up with your total loan, your total project costs, and we're gonna lend 80 to 85 of your total project costs. So that means you're gonna put down 15 to 20%. Now, if the seller is willing to do a carryback, that can help, and you could bring in less proceeds. But the bank's probably going to lend 80 to 85% of total project costs. So that 3.2 million, we're going to lend 80 to 85%. Construction funds are held back in a reserve account, and you're not going to get that up front. As you make progress, those funds will be drawn out. And 7A loans are based on Wall Street Journal Prime plus a margin. That's your fully indexed rate. It's just quarterly. Very few SBA 7A lenders will do a fixed rate term. And probably rates will come back down, hopefully. They're going up right now, but I think 12 to 24 months from now, they may start coming down again. These come with a 3-year prepayment penalty. So on something would I consider a value add like this, because it's got no income and you're going to make a bunch of income once this is operating, you're going to want to refinance anyways. So instead of going into a 504, which has a 10-year prepayment penalty, the 7A would be better because it has a 3-year prepayment penalty. So that's the way we would assess this, Matthew. You can follow up with a phone call if you'd like, but I get that question a lot, Bill, because there's a lot of these boutique motels everywhere, and a lot of them are in good tourist destination. They just haven't been running with technology. So these people that understand the tech stacks of how to run these. Actually, I just saw Airbnb just made a proposal. They're going to open the first hotel in Las Vegas. It's going to be completely no employee. I mean, they're going to have housekeepers and stuff, but it's going to run itself. So that's going to, I think Airbnb will probably start doing that more and more often.